got an oddity here. In recent years, the lodging real estate investment trusts have been hammered. Now, a lot of this is just, I think, a little faux worry. It's a flood of competition from outfits like Airbnb, Verbo. Remember we had them on? But how can we tell when these stocks have been punished too much? Take Hersha Hospitality Trust. Now, this is a small-cap real estate investment trust. Owns 48 mid- to high-end hotels, mostly in major metropolitan areas along the coast. Think Boston, Philadelphia, Florida, California. Over the past 5 years, Hersha's stock price has been cut in half. And this reported a challenging quarter last week, but when you drill down, there is a new wrinkle here. In 2017, some of the company's key Miami properties got hit by Hurricane Irma. Now, though, Hersha is ready to put those hotels back into service right in time for the Super Bowl, where you can't get a hotel room. I can tell you that already in the beginning of February. If you believe they can make the numbers, well, this stock's got an 8% yield. I think it's big. I like it. Which is why I want to take a closer look with Jay Shah. He's the CEO of Hersha Hospitality Trust. Learn more about how his company's doing, where it's headed. Mr. Shah, welcome back to Mad Money. Good to see you.
Good to see
Thank you so much for coming in.
Thanks for having me.
All right, so sometimes I say to people, look, 8% is a red flag, but your group has been under tremendous pressure. You've got no problem with cash flow, and you also have this upside from Miami. So why don't you tell people, because it's been a while since you've been on, why this is attractive at this level?
Yeah, I think, you hit on some of the high points before. We've had, in addition to being disrupted at two of our big hotels in Miami that, together comprise close to 10% of our EBITDA. We had those offline for a whole year, and they're back online. But after you close a hotel for a year, it takes a year to 2 years to ramp up. I think the South Florida dynamic with the convention center being open again, the Super Bowl coming, next year Miami is expected to be the top growth market of the top 25 MSAs. And so that gives us a lot of optimism on really filling that hole, which we've been living with for about a year and a half now. And secondly, what we're also noticing is that it's a bit of a risk-off environment right now with hotel stocks. And I think that's kind of driven by some of the uncertainty. But I think what's being overlooked in our stock is across the last 2 to 3 years, we've done two very strategic initiatives. I think that was driven by the fact that we saw RevPAR decelerating a little bit because of uncertainty. So starting in 17 and 18, we have recycled close to just under $1 billion in capital. We sold hotels that we felt were mature and weren't going to be producing at more than market level growth, monetized the value on those, and bought newer assets, more strategic, pure play to our strategy with much higher EBITDA growth profiles.
Okay, so what people need to know, I always stay, I don't mean to be brag, I happen to love the Rittenhouse. And that's why I always stay when I go to see, I see you at the Eagles games. It's the best hotel in Philadelphia. I don't think there's much doubt about that. But you also have a cluster strategy that I like. And that seems to, I think, immunize you in a lot of ways to where the economy might be.
Yeah, I think, it does help us a lot because, with the cluster strategy combined with the fact that we're very market focused, but somewhat agnostic to segments. So, you mentioned the Rittenhouse, leading hotel in Philadelphia, and, very productive investment, a great hotel. But we also own the Westin, and we own the Hampton Inn at the convention center. And so the cluster strategy creates some synergies for us. With SG&A and overheads, it allows us to share consumer insights. Sales and distribution strategies are positively impacted. But it also, having multiple segments in the same market, different segments peak and mature at different times in the cycle. So it allows for us to have growth throughout the entire cycle rather than it being peaky.
Okay, now there is not enough people cover you, and I've known your company for years. There is an outfit, BMO, that has you rated as an underperform, and their headline is "Sour Big Apple." That you do have 24% of your businesses in New York, and that New York is weak. Now, I get varying reports about New York being weak. I also feel, to me, that Airbnb may have peaked.
Yeah.
Or they would have come public, frankly. Yeah. Is Airbnb, did it erode a lot of the business here, and is it coming back?
Yeah, I think, Airbnb has definitely had an impact. We have to be honest with ourselves. And where we feel the most impact from Airbnb is on compression nights. That's when, the cities used to compress out in the inventory, and that allowed, with dynamic pricing, to drive stronger ADRs. And Airbnb, by creating a lot of shadow inventory, diluted some of that. And compression nights have been down. That being said, we're seeing with Airbnb as cities are starting to enact legislation,
Right.
to so that they're not illegally sidestepping hotel regs and renting rooms as illegal hotels. You're seeing a real drop-off. Santa Monica and San Francisco, after legislation was enacted, close to 6 months after, you saw a 50% drop in listings. And so as more and more jurisdictions pass legislation
and there are many in the pipe for a lot. Do you see it happening?
Yes, well, for sure. We're seeing it. We're seeing it across lots of markets.
In some of your key markets, Washington, with that St. Gregory, or New York.
Yeah, well, in New York, you're seeing that the number of the growth has flattened out.
Right, that's
and so
absolutely
now you
true. So
can
check that for when I hear about. I'm very down on a lot of these companies that have become public. Okay?
Right.
Airbnb would be one this market doesn't want right now. The growth is flattening as far as I'm concerned.
It is flattening. It is flattening, which for us is a good sign.
Yes.
Because, like when you talk about New York, it is 24%, and there is supply growth. So, forgetting even the Airbnb, there's been a lot of growth there. And everyone gets very focused on supply growth, and we all should be. But more importantly, it's the demand and supply growth dynamic that matters. And for the first time in several years, we're going to have 4.8% demand growth in New York with only 4% supply growth.
This is the inflection point.
Yes.
I think the 8% yield is terrific. I've known you, and I've known your business for a very long time. I think it's an anomaly that has to be taken advantage of by people who watch. That's Jay Shah, CEO of Hersha Hospitality Trust. 8% yield with improving fundamentals and a very big term in Miami. And you just heard about the supply demand in New York City and the laws that are changing that are in your favor out west. Mad Money's back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.